Hi everybody and welcome back. Today we're going to talk about risk. Yes, risk, everybody's favorite subject, but more specifically we're going to talk about managing risk. A good example of this would be car insurance. So for example, you pay the insurance company money and then they agree to cover you to pay for it if you get into an accident, somebody breaks into your car catches on fire and so on. Well, they're looking at risk too. You're a risk to the insurance company. So what they want to know is the likelihood that they're going to have to pay off to you. So if you have a lot of speeding tickets, you're more likely to get into an accident than somebody that doesn't. Because of that, they're going to charge somebody with a lot of tickets more money than someone who drives safe. And that's the insurance company managing risk, but it's also you managing the risk that you get into an accident. So that's how we manage risk. When we're talking about investment risk, what's the most risky investment you can possibly have? Probably a lottery ticket. And that's extremely risky because the chances are you're going to lose all your money. Now that's a very high likelihood, but the payoff is huge. So many of us are willing to risk $1, $2 in exchange for the opportunity to win $500 million. However, that's risky. You're pretty much going to lose your money. And we all know that. When I do talk about risk with clients, the first thing that pops into their mind is, I don't want to lose all my money in the stock market, which is a valid point. Who does? Nobody wants to. So how do we manage that risk? We want to manage the risk that you're going to lose all your money in the stock market. Well, one of the ways that we do that is by using the indexes that I talked about before. So we take an investment and spread it across many, many different companies. So we're not at risk of one company going bankrupt. If that happens, we still have maybe 400 or 500 other companies that didn't go bankrupt. And that's one of the ways that we manage investment risk. Another way of doing that is diversification. Sometimes the stock market like this year can be extremely volatile, up and down and so on. So we may have some bonds in there, we may hold some cash, we may have various other things that are not doing the same thing as the stock market. And that's a way of diversifying away risk in our investment portfolio. But what if I told you that I had an investment? It's not going to bounce up and down in value every day. It's pretty much going to stay steady. And you look at the portfolio tomorrow, it's going to be worth the same as it was today. Sounds pretty good until I tell you that you're guaranteed to lose 7% a year. Lose? Why would I want that? Well, I wouldn't. But there's really trillions of dollars in an investment just like that, and that's called a bank account. Your savings account maybe pays 1%, which in a lot of people's minds say, yeah, it's only paying 1%, but it's safe. Is it really? We have 8% inflation right now. So let's just say, for example, you have $100. Next year, it's going to cost $108 to buy the same thing that same $100 bought. But because you made 1% on your bank account, you now have $101, but it costs $108 to buy the same thing that it costs $100 today. So that's a risk as well. Inflation risk is very real. We haven't really had to face it for some time because inflation's been pretty low, but that is something that we need to pay attention to. If we have money in a bank account earning 1%, we're guaranteed at these inflation rates to lose 7% a year. So we want to diversify that risk away too. One of the better ways of doing that is the stock market. I was just looking, if you invested, and frankly none of us did this, maybe a couple people in the whole world invested $10,000 when Apple first came out, you'd have $6.7 million. I have a story that many of you have heard about. I bought Apple for, I put $1,400 in it, and it would be worth over $1 million today. But I was scared. I got out of it. I didn't want to lose money. That's one of the reasons that we want to stick with our investment plan. We can't have the fear because one of the best ways of handling inflation risk is the stock market. One of the best ways of handling the stock market is to be diversified. That's all I have for you today. Thanks for coming in. We'll see you next time.